of questions I've been getting from advisors recently regarding structured products are why they're not covered by the bank deposit guarantee scheme.
Yeah, fair question. It goes back to the original conversation I suppose we had around the structure behind the structured product, okay? Right. So a few years ago, yeah, they were all deposits. And if you were a deposit, you were covered by the deposit guarantee scheme. And that was a great sales feature and a feature of a product from a client's perspective, that the first 100 grand of your investment with any bank was going to be protected by the deposit guarantee scheme. Yeah. Fantastic, okay? That world doesn't exist anymore, okay? So you can still get deposit guarantee if you want to put your money with the bank and get zero interest or potentially negative interest, and you still have your guarantee over 100,000. But structured products aren't in that space anymore because banks don't want deposits. They don't issue structured products as deposits anymore. So it's a like we said before, it's a senior unsecured note. So it's the most senior instrument that they can issue beyond deposits. But if you're not a deposit, you don't get to the guarantee scheme.
Well, Adrian, thanks for explaining that. Another question I think that I'm getting a lot from brokers is to do with costs. Now look, every investment instrument or every investment product has a cost, but there's perceived to be higher costs associated with structured products. Can you explain how the cost or the charges work?
No problem. I think the key word there is perceived. I think a lot of the times here it is a perception. One of the great benefits of structured products is that they have been forced to be, over the years of regulation across the industry, but particularly on structured products, it's been probably an over-regulated space, that the transparency is as high as it can possibly be. Okay, so we have always been very transparent on fees and costs and charges, and then I suppose MiFID II came in and introduced the KIDs, which provide an even greater level of transparency and force cost disclosure on the underlying bank as well. So, I mean, again, I'll talk kind of generals. Most of our products, whether they're around 5 or 6 or even 10 year, kind of operating around the same fee structure, okay? So it's typically around 4.5% these days as a total upfront cost to the investor. Right. Okay? So maybe that perception comes from all of our charges are upfront on day one. So it's easy for someone to say, well, this is 4.5% and I can go into this fund over here for 1% or whatever else it is. But we don't charge anything else after that, okay? So if you take your 4% product, over 5 years, we charge you 4% and then nothing again throughout the rest of the product, okay? There's no annual management fees, there's no fee at the end, it's just a straight upfront fee, okay? And that fee then gets split up. Is BCP typically take about 1.5% of that, and the advisor takes maybe 2.1, 2.2%, and then the balance is used to pay custody and administration charges to our custodian for safekeeping of the assets. Okay, so for BCP as a product provider, we'll make around 1.5% of that to cover everything that we do. So it's not a huge amount over a 5-year product; it's equivalent of 30 basis points per annum. So I don't see that as a high cost. Okay, it's a cost that we don't make a huge amount of money out of that, so it's very much a kind of a volume game for structured product providers. It's also a reason why there's not many players left in the industry. People who need to take a higher margin aren't able to operate in this space. And the reason why margins are lower is for the same reason as everyone else, interest rates are lower. So there's less spend within the product, but we can live on those margins, okay? And the broker gets his commission up front on day one.
I suppose you touched on it earlier that a lot of product providers have come and gone in the Irish market and generally don't stick around for too long. But I know BCP have been, I suppose, in existence for, is it 50 years, your anniversary this year?
We celebrated our 50th last year actually, so we're into our 51st year this year as an entity, I suppose. Under the kind of the current management, it's over 30 years. Right. We've been doing structured products now for nearly 30 years in the Irish market. So yeah, we've been here for a long time. We've seen it all, and we've gone through a lot of different kind of economic environments and local and international market kind of events. We know how to put structured product together. We're quite a conservative firm, and I think that's something that you see kind of across the board at BCP.
I think that came across today.
Yeah, and that's fine. Again, it's our case of saying, look, there's no one right way to do anything, okay? No. And that applies to structured products as well. So we err more on the conservative side of things. So, for example, we won't do an individual stock basket where we're tracking 2 or 3 companies in a kick out. That's just a higher end. It doesn't mean it's wrong. It's just not how we do it, okay? So yeah, we've had a great run. Structured products are a part of the business. It's not all of the business. We've got a property business that operates quite well. There's a business servicing the credit union advisor market that does very well and has become a very big part of our business over the last few years. So I think being diversified helps because it's not all sweet and rosy in the structured product market when you're going through a very low interest rate environment as well, and I wouldn't ignore that for a minute. But we've got a very stable, kind of well-run, conservative company that has been here for a long time. We've never had any issues in terms of bank counterparty issues where investors have lost money because banks have gone out of business. Consistency, stability, conservatism, I mean, they're core tenets of the BCP business model. Yes, we've seen companies come into the structured product market and you see it straight away. They come in with big splash and aggressive products and high coupons and promising the world, and quite often you see that kind of dissipate out because that's not a sustainable way to run the business. It's a very regulated industry, operating under MiFID II regulations and standards. You need to have very high minimum capital requirements. You need to have a very robust business model that the central bank is keeping a close eye on, and we're very well kind of set up in that market, and long may it continue.
Good. Well, look, I suppose that's the longevity of your firm is comforting for investors and advisors alike. So thanks for explaining that.
Absolutely. Thanks very much for your time, Christian.